Hi everyone. I hope everybody is having a wonderful end of their summer. As I tell my kids, this is my favorite time of the year because they're back in school with a lot less free time, so they don't ask me for as much money, which always is a good thing. But anyhow, speaking of money, let's look at how the market has done in July. Actually, the market continued to creep itself up. We were actually up 2.3% on the S&P 500 in July, and so we've continued to see that momentum to the upside. One thing that I mentioned last time that would be a big factor for the market is what our corporate earnings and corporate revenues look like. Now that those are all behind us, we can actually take a look and see what took place, and it was really interesting. Corporate revenues were actually up 83%. That's the highest that they have been up since FastSet, who I got the data from, has been tracking it since 2008. That's the highest that they have been up. But we kind of knew that corporate revenues would be higher. What we really wondered about was, were corporate earnings going to be, what were the earnings going to look like? Were higher costs going to have worked themselves in? And actually, corporate earnings were up 88%. Once again, the highest since 2008. So corporate earnings looked really good, as well as corporate revenues. One of the things that did come in a lot of the conversations and the earnings calls was higher costs. They're definitely seeing higher costs come in, but they're passing those costs along. So Coca-Cola, Procter & Gamble, Unilever, Smuckers, virtually everybody that has raw goods that are being purchased are seeing costs escalate quite substantially, but they're passing those costs on. And so that's something that I think inflation is really important when it comes to portfolios over the next 4 to 6 quarters. And so I'm going to do a second video, kind of an inflation 2.0 video that'll be out in just a few days. So be looking for that. Past that, obviously the other thing that we've been watching is the housing market. We have a lot of real estate investors in our firm, and the housing market has continued to stay very competitive. We don't really see that kind of falling back anytime soon. The one thing that is interesting is with new home sales. New homes, because of the fact that it costs so much for the raw goods now, they can't really build entry-level homes. They're essentially building medium to larger houses, but inventories have started to build there just a little bit. They went from a little over 3.5 months to almost 6 months worth of inventory now. So it will be kind of interesting to see if that continues to build, if that slowdown continues to show itself. And what you're basically seeing there is consumers being priced out of the market or not willing to pay the prices for the new homes. So that is something that we're watching. Once again, just another sign of inflation. So I would continue to look out for our inflation video, and we can talk more about that. Looking forward, September and October tend to be rough months for the market. Actually, I would love to see the market have about a 5 to 10% pullback. I think it would be very healthy for the market and give us a great opportunity to continue to grow into the end of the year and then the first quarter of 2022. One of the things that I thought was interesting is JP Morgan just raised their S&P 500 estimates. They are looking for about another 5% increase from July's numbers to the end of the year. And they seem to think that the market can continue well into 2023. I'm not quite that optimistic, but I definitely feel like we can get through the end of the year with the market still in an upward momentum. Once again, if you have any questions or even any financial questions at all that we can assist you with, please never hesitate to call, and I look forward to speaking with you soon. Thank you.